Hello friends, welcome to today's session. Today's session would be on issue of debentures as collateral security. Now to understand this, first let us understand what is collateral security. As a background, you need to know that when any loan is taken, like for purchase of a asset, so when there is a purchase of an asset, which can be in the form of a building or a machinery, then the company might go to a bank and try to take a loan so that it can purchase these assets. Now, at that point of time, for the loan to be given by the bank, this particular property which is being purchased, asset which is being purchased, is normally mortgaged to the bank, which means it would be in the possession, documents would be in the possession of the bank till the loan is repaid off. So when such an asset which is being purchased, on which loan is being taken, is mortgaged, then we say that these particular assets which have been mortgaged have been given as principal security. The other term that is also used is, it is also called as primary security. In case the company does not repay the loan, then that particular asset can be taken over by the lending institution, that is the banks. However, sometimes some additional security might be given. In addition to whatever has been given here as principal or primary security, some additional security can be given. Like in our case, which we are studying, is issue of debentures as collateral security. Debentures might be issued as additional security, and that we call as collateral security. So the additional security given by way of debentures is called as collateral security. Now, very important point about such debentures which are issued as collateral security is they are going to be issued only when there is a default in the loan. Till the time it is just specified, the debentures would be issued. In case there is a default, then only actually the debentures would get issued. Till the time it is just going to be in terms just given in writing that as a collateral or additional securities, debentures are issued to the company. If the loan gets repaid, so basically you understand that if the loan is not repaid, then as I told you, these debentures would be issued to the bank. But if the loan is repaid off, then what happens? These debentures would be returned back to the company. So they are not going to be held back by the bank. It will be returned back to the company. It would be cancelled out. It would not be exercised by the or taken up by the bank. An important point is, on these debentures which are issued as collateral security, there's an important point that you have to remember, that in respect of interest that is paid on debentures, no interest can be claimed. So when there are debentures issued, the debenture holders get return in the form of interest. But when debentures are issued as collateral security to such lending institutions like bank, on that bank will not get any interest. So I hope that is clear about what is meant by collateral security. Now, moving further, let us understand the accounting treatment of the issue of debentures as collateral security. Now, the accounting treatment part, what we are talking about is how you are going to show it in the books of accounts of the company which is issuing its debentures as collateral security. There are two ways, first and the second. Under the first method, journal entry is not passed. So here what is done? When debentures are issued as collateral security, they do not pass any journal entry. They just reveal it by way of a notes. In the notes to accounts, where that particular sorry loan is being specified, under that an explanation is given that so much debentures have been issued as collateral security. So this is how the accounting treatment would be for the debentures issued as collateral security when the company decides not to pass any journal entry in the books of the company. But there is a second method where the journal entry is passed. So if the company decides that for the debentures it is issued as collateral security, it would pass a journal entry, then the journal entry that you would pass in the books of the company would be debentures suspense account debit to whatever is the percentage of that debenture account. Now this would be the journal entry that would be passed for the debentures issued as collateral security. So when the loan gets repaid off, this particular entry would be reversed off. In case the loan is not repaid off, you reverse it and then issue these debentures as actual debentures to that particular lending institution. So this is how there is two varying accounting treatment. On the basis of the treatment they are asked in the question, they say without passing, the companies decide not to pass journal entry, then you would have to take up this accounting treatment in the balance sheet. And if they say the company has decided to pass a journal entry, then you will have to pass this journal entry and show its effect in the balance sheet. Now let us understand this concept using a question. It will be more clear. Look at this question. There is one company, Harry Limited. It has taken a loan of 80,000 from Dena Bank and it has issued 1,000 10% debentures of 100 each. So 1 lakh worth of debentures have been issued as collateral security for a loan of 80,000 which Harry Limited has taken from Dena Bank. Now they say show how the issue of debentures would be shown in the balance sheet. Now how would we show it? In two different circumstances. One, when no journal entry is passed. Two, when journal entry is passed. Now, important point before this is here they have not specified what type of loan is this. Now, basically loan is nothing but the borrowings of the company. Now, the borrowings can be of two types. It can be a long-term borrowing or it can be a short-term borrowing. When it is a long-term borrowing, you need to note that it is classified under the non-current liabilities. Under the equity and liability section, under non-current liability, you have the subheading of long-term borrowing where you were classified. But however, if that borrowing was a short-term borrowing, then under equity and liability, you would have the heading of current liabilities. Under the current liabilities, you're going to have the short-term borrowing where you would specify this particular loan of 80%. So knowing this, now we will see the situation, how we will show it in the balance sheet when no journal entry is passed first. So when no journal entry is passed, we are not passing a journal entry, we are just going to show it by way of detail. So first, in the balance sheet of Harry Limited, we are just showing the extract here as at the particular date. You have first here the equity and liabilities side of the balance sheet that we are preparing here. Under that, let us assume that it's a long-term borrowing. Therefore, it would be under the head non-current liabilities. So, if it was a short-term borrowing, then it would have been, the subheading would have been current liability. So, assuming that it is long-term borrowing, we put it here and then subheading would be long-term borrowings. Now, the long-term borrowing, we'll put the note number 1 and we prepare the note number 1 here for the long-term borrowing. Here in the long-term borrowings, we would be giving the detail. This was a loan taken from Dena Bank. So we'll write loan from Dena Bank. The amount comes to 80,000. And as we are not passing journal entry, we would just specify that this particular loan is secured by issue of 1,000 10% debentures of rupees 100 each as collateral security. So this is the accounting treatment when no journal entry is passed. We are just disclosing the fact that so much 1,000, 10% debentures of 100 each have been issued as collateral security. And that amount is posted into the balance sheet. The amount of loan. Now suppose the company, Harry Limited, decides to pass a journal entry. Then how would it be shown in the balance sheet? First thing, we will pass the journal entry for the same. The journal entry would be debenture suspense account debit to 10% debentures account. So how many debentures were issued? Issued 1,000 10% debentures of rupees 100 each to Dena Bank as collateral security. So this is a journal entry that would be passed, and it is for 1 lakh amount. 1,000 debentures of 100 each makes it 1 lakh. So now when we show it in the balance sheet, how would it appear? It's very simple. Again, it is going to appear on the equity and liability side of the balance sheet. Under that, on the basis of whether it's a long-term or short-term borrowing, you would classify it. If it's a long-term borrowing under non-current liability, and if it's a short-term borrowing under current liability. Now let us assume it's a long-term borrowing. So we'll put it under non-current liabilities. Under that, we have the loan, long-term borrowings. Note number 1. In the note number 1, now here the long-term borrowing, we are going to give the detail. How do? We have an entry here. So we will be writing whatever is the loan from the Dena Bank, that would be appearing here at 80,000 rupees. But for the second part, we are going to show that there were 1,000 10% debentures of rupees 100 each issued as collateral security. That is rupees 1 lakh. Let us have two amounts. That would be better. Here, less. So these 10% debentures were written on the liabilities side. Now, debenture suspense is subtracted here. We will write less debenture suspense count of 1 lakh. So what happens? Net amount is dash. So total that goes here is 80,000. So this is how you represent when a journal entry is passed. There in the first case we just wrote a note, but here we are going to just show it that so many debentures are issued and we subtract it with the debenture suspense. And in this way, actually only the loan amount is going into the balance sheet total. As long as the loan is being repaid, this is not going to be exercised by the bank. Now, moving a step further, let us assume that this Harry Limited is unable to repay the loan, and the interest payable on this loan is 20,000. So already the loan was of 80,000. Now on top of that, they have interest payable of 20,000 as at the end of the year. Now, as the company is not paying, now bank has decided to exercise its right vested in debentures. So it says now issue us the debentures that you gave as collateral security. So first thing what you have to do in this case is you would, as on that particular end of the year, write that date and you would reverse the entry that was passed. That is, you would reverse this particular entry which was passed when the debentures were issued as collateral. So the entry now would be 10% debentures account debit. 1 lakh to debenture suspense account 1 lakh. So this is for the reversal of debentures issued as collateral security. Now what would be done is now the debentures would actually be issued in return for the loan and the interest. Now loan has a credit balance that is going to get closed out. So you would debit it. The loan account debit 80,000. The interest of 20,000 was payable, so it's a liability having a credit balance that will also be closed out. So whatever is that interest payable account, that is also debited, and that is going to get replaced with these 10% debentures of rupees 100 each, 1 lakh. So this is how there is conversion of loan and interest payable into debentures. So now there is no more loan account or interest payable in the books of the company. It is being replaced with 10% debentures which get issued, and now bank holds in its hand 10%, 10% debentures of 100 each. So this is how you would do the accounting treatment when the company is unable to repay the loan. I hope that is clear. So now here I've given a self-assessment question on the same lines with changed amounts and figures. You can try this question by yourself. I will post the solution tomorrow. So friends, did you find this video useful? If yes, then please do like and share the video. And if you have not yet subscribed, then please do subscribe to the channel to get continued notification of all my upcoming videos. So thank you all for joining me today. Have a great day.